Broadcasting from, sorry. My bad. Broadcasting from Mr. Small's Theater for the first time. You are listening to Funny Money on the River. Can we start over, please?
Let's do it.
All right.
Start over. 1, 2, 3, go.
Broadcasting from Mr. Small's Funhouse Theater. No, Mr.
Complex.
Yeah, the Mr.
Wherever
Small's,
the hell we are.
right, Mr. Small's Theater, I suppose. You're listening to my. Oh my God! Why do I want to say money funny? You're listening to Funny Money on the River's Edge. Okay, I'm Tom, and producing the show is Brian.
I'm Crawford Bryan.
All right, so we have tonight. We're talking about investment companies, and it's kind of funny. We're investors, and they're investors, but we're hoping that they're really good investors, and they can make us a lot of money. But a lot of it's not really, well, how good of an investor are you? It's how many clients do you have? But in the case of the first one I'm going to talk about, a lot of it actually does have to do with how good of an investor they are. And that's T. Rowe Price. And T. Rowe Price began with Thomas Rowe Price. Imagine that. He was born in Glendon, Maryland, into the hands of his own, I can barely speak, into the hands of his own father.
I gave him a beer for the first time on this
I know.
show, and look what happens.
I had half a beer, and I'm like, all right. So he was born into the hands of his own father, which is very unusual, Dr. Thomas Rowe Price, who delivered him. Okay, Price's mother, Ella's maiden name was Black. And her nephew, which would have been T. Rowe's cousin, was S. Duncan Black, one of the two founders of the electric tool company. You may have heard of it, Black & Decker. So it's kind of like, entrepreneurialism runs in the family to some extent. Very successful, both of them. So T. Rowe went to school in Maryland, and in 1919, he received a bachelor's degree in chemistry from Swarthmore, which is in Pennsylvania.
Is that a real school?
Yeah. Why?
I've never heard of Swarthmore.
Yeah. You've never heard of it?
No, what's Swarthmore?
No, it's in Pennsylvania. It's in eastern Pennsylvania.
They suck over there.
Yeah,
I never heard of Swarthmore.
Like
it sounds like a fake
arts,
name.
Small liberal arts school.
It sounds like a fake name. It sounds like a Harry Potter name, like the name of like a house in Harry Potter.
Swarthmore.
Yeah, you've got like the magic hat, or you're in Slytherin, you're in Swarthmore.
Yeah. Yeah, right. Well, Slytherin is pretty sketchy sounding.
So Swarthmore.
Swarthmore, would be a character in Slytherin.
Okay, that makes sense. Yeah, being corrupted
Right.
at a young age.
Right. Swarthmore, go fetch me the frog heads. All right. So, So he graduated with a degree in chemistry, which is interesting. T. Rowe. So with that degree, he initially sought a career with DuPont, which was the biggest chemical company in the country, and still is in the world, in fact. Actually, before I say that, I'm not sure. BASF might be bigger. But so T. Rowe soon realized he was more interested in money management than scientific research and left DuPont to join a series of small investment firms and brokerages. Mm-hmm. So after a decade of working in the industry, Price began to recognize there were other considerations to a stock's future price, than whether or not it appeared cheap, which is like standard value investing, right? So you want to, like, I put a lot of emphasis on value investing. So, I look for companies that have a low PE, low debt, and good return on invested capital. So, and good growth too. So I'm looking at that too. But and I always like to see something more than just that. Something that's like they've got some kind of coal in the fire.
Okay.
Something that's going to yield them future returns. So what he kind of, but everyone really was just looking at the stocks from a value perspective at the time. And this is during the Great Depression too. So I'm sure, whether something was cheap was a huge consideration then. All right. So that's the value investing.
Everything's cheap now.
What do you mean everything's cheap
Everything.
now?
It's like, I don't know. Everything's cheap. Everything's done cheaply.
Nothing's what, above the board? Is that what you're saying?
Yeah, we don't invest in things like we used to. We do things on the cheap now.
Things the market isn't that cheap.
Okay.
It's not. It's gotten to a level where it's mostly pretty expensive.
They were saying that today. I was listening to the news, and they were saying that it's extremely expensive right now, and they were afraid of a bubble.
Yeah. I think that's, there are some reasons for concern.
Are you worried about bubbling?
Yeah, a little bit. That's always bubbling on the back burner.
Yeah.
The last one was bad, so.
Yeah.
And I managed to sidestep that one.
Nice.
Which was really nice.
This is why you got to listen to Funny
Shorted
Money.
Lehman.
See?
Yeah. So.
You saw it coming.
Saw it coming. But if you go back to then, I was definitely not the only one who saw it coming. It was actually like the real estate bubble was a frequent topic of conversation on CNBC back then. In fact,
You're
it
the
used to
only
be
one
like,
that got out of it, right? Like everybody else.
Well, not
they all
everyone.
suffered.
No, there were.
Why don't we make it sound like you're like the money mastermind here? Yeah, and everyone
Yeah.
needs to.
No. I mean, it wasn't that unconventional to think that, hey, this is a bubble and this could burst. And we're lending to people who can't afford to pay these mortgages.
See, I feel like that's a really crappy analogy because there's no pop. If the bubble's going to burst, there should at least be like a...
You
Boom.
mean an actual sound?
Yeah, like an actual sound of a pop. I don't know, like the realtor association, like they should have like a big
But
like.
isn't the pop to like all of our egos, when we like suddenly realize the emperor has no clothes?
So I didn't invest at the time, so my ego was my balloon was still
All right,
up, living
fair
up.
enough. Okay, all right. So T. Rowe was the first. T. Rowe Price was the first guy to, really verbalize this concept on record, and so that the idea that growth, that a company, even when fully valued, if there's certain things about it that make it look like it's going to be a big grower, then there is value in that. So he is considered by many to be the father of growth investing. And it's the idea that you would invest in companies that were expected to grow faster than the overall market and achieve superior returns even if they were fully valued by the market, quote unquote, fully valued. So that idea was controversial. Nobody else was doing it that way. And he also had this idea that, like, he didn't believe the way that they were paid on commission was the right way to be paid. He thought, because on commission, you're paid for each trade that you do, right? Now, or each share that you trade.
Yes.
So if, regardless of what happens to the client, regardless of whether the stocks go up or down, whatever they buy. But Price thought it was important to tie the performance of the client's portfolio to the reward that the investment company got. All right, and so what he wanted to do was that, in that regard, was also controversial, and his disagreements with his peers caused him to leave the firm, where he was the chief investment officer, which is a sweet position. Obviously he was well regarded in terms of being able to invest. He started his own firm and called it T. Rowe Price and Associates in 1937 at the height of the Great Depression, which is
Wow.
kind of crazy. I remember
It's a risky time to start a business, huh?
well, 1937 there was like another crash in
Oh, wow.
1937.
On
Yeah.
top of the Great Depression.
Yeah, well, there was a stock market crash before the Great Depression, immediately preceding it, right? 1929.
So it sounds more like manic depressive.
Then there was depression, and the market was starting. I mean, things were starting to recover, like in 1935 through 36 or so. In 1937, market crashed again, and there was like another depression
Okay.
or deeper, you know. So that I would consider would be the height of the Great Depression, or the nadir of the Great
Okay.
Depression, however you want to look at it.
Well, here's a question I've always wondered, and you know, I have my opinions, but they may not be accurate because I'm not an expert on the economy. Did FDR help, or did he hurt in the Great Depression? His policies like where he federalized a lot of
Right.
programs and put in a lot of social programs. Did that end
Now,
up
that's really
prolonging the Great Depression?
Complicated.
Okay.
Well,
Because some people
it's
say,
the only Great Depression that we've had.
but some people say it actually made it worse, or at least prolonged it in some ways, and other people say it's the only thing that got us out of the Great Depression.
Oh, I definitely don't think those programs got us out of the Great Depression, because that went all the way up into World War II without stopping. And in my opinion, just the way that I look at it is that we were still in the Great Depression in World War II.
Yes.
In fact, the standard of living in the United States dropped significantly after we entered the war. You can imagine, because of rationing and things like that.
Definitely. This country was all in on World War II.
Right, but certainly the economy in the United States was still in depression in World War II. Mm-hmm. I think. I don't think it was until after World War II that it really got out. And I have opinions on what got us into the Great Depression, and I think Hoover is mostly to blame for
Really?
getting us in.
Because some people say that he didn't really get us into it. He just it just didn't seem like he was that energetic type of a guy.
Well, this is what his problem was. In my opinion, and this isn't something that people often cite, except for Ben Bernanke or somebody who really knows, or me, who pays attention to trade. But I think that the stopping international trade was the cause, the root cause of the Great Depression. And how did that happen? Well, there's something called the Smoot-Hawley Tariff,
Okay.
which passed, not coincidentally, in 1929, prior to the crash. Mm-hmm. And what happened was, and Hoover signed it into law, right? So what happened was we raised tariffs on all imports by 40%.
Wow.
Not that I've ever heard that proposition before.
Yeah.
But on all imports by 40%. So what happened was there was retaliation across the globe. Europe, all the European countries put 40% tariffs on our products.
Wow. So
And
it was
the Asian
it was
countries put
yeah.
40%. And then
So really, we were almost in a global economy there
and
with
then
with
what
free trade.
happens? Right. Okay. So you can't export your cars to sell in France because there's this huge tariff which makes them not at all competitive in the market. You can only sell them in the United States. So what happens though? Okay, so that's a smaller market. So what you have to do is produce fewer cars. What happens? How do you produce fewer cars? You lay off workers, right? You lay off workers. So, but then it's sort of self-defeating because that's happening all across the country in various industries, and so the population that you're trying to sell to is getting poorer and poorer as this process goes. So you have to carve away the first layer of workers, right? Because they were making the cars that were exported.
Okay.
All right. And then once you do that, the whole country is a bit poorer because there are a lot less people earning incomes. If you think of this going on in all of the industries that exported. Then what happens is you have to sell fewer cars in the United States than you anticipated. So you have to remove another layer of workers.
Okay.
And you can see,
and
and then
it keeps
until we're
going.
at 25% unemployment.
Wow.
That's what it was, 25%.
Wow. So one little,
We're at
well, not little, but
point-
it's a pretty major tax, but one tariff really maybe maybe it wasn't. It was part of a multiple.
Right. The fact that it was set up that we had the system in which that could be the straw that tips the camel's back or whatever is part of it. But it wasn't really a straw. When you're like, okay, no more, hey, goodbye world.
Yeah.
We're just going to hang out by ourselves.
But wasn't
It
FDR
doesn't
somewhat
work.
of a, in some of his policies, wasn't he somewhat of a protectionist as well?
Well, probably. But I do know that the Smoot-Hawley tariff, I don't think, it wasn't repealed until the war.
Yeah.
Okay, but so we were in a very protectionist state that whole
That's what I thought.
time during the Great Depression. However, FDR didn't get us out of the Great Depression, so I blame him for that.
Sure.
I don't think his policies were effective. I don't blame him for getting us in. I think that was mostly
Yeah, I
Hoover
think most people.
into the Congress, but passing the stupid tariff. But I do think he failed to get us out of the Great Depression. Those programs are goofy. I mean, if you think about it, if you pay someone to dig a ditch and then fill it back in,
Yeah.
you know, that the problem with that is that, yes, okay, it's good that it gets money out into the economy and he can go spend it on something else. But in order for something to have economic benefit, a transaction to have economic benefit, you have to have a third product. You have to have a product of the economic activity. So, the product, even if it's a bet, and that just seems like, well, it's a transaction, the product is actually the thrill of the bet. The enjoyment that the people get out of having the bet, right? All right, so there's always, in any positive economic transaction, there is some product. But if you dig a ditch and you fill it back up, it doesn't make anyone happier.
Yeah.
It doesn't.
Well, the person that's getting paid is happy.
Well, they
Happier.
feel like they're feudal.
Sure.
Also, it doesn't. There's no net benefit, really.
Okay.
So that's the problem. You got to do something that's needed. Although I will say some of FDR's programs were needed. I think Tennessee Valley Authority did a lot of good stuff, the hydroelectric power and whatnot. But
Is this a winner?
a lot was not.
But the first stock, is it a winner or a loser?
Okay, so yeah, all right. I'll get into.
I know we went off on a complete tangent.
yeah.
That's my fault, but I was
right.
very interested in that. So
All right, so T. Rowe Price came up with these ideas about growth stocks, and he founded his own company. All right, yeah, it was at the height of the Great Depression. Okay, now he also so he didn't charge fees based on he didn't charge commission. He charged fees based on the value of the investments under management. So if the client's stocks performed well, the value goes up. And then the people managing the investments get paid more. Which makes a lot of sense, rather than just based on the volume of shares that you buy and sell. He also demanded that proprietary research guide investment selection, which is important, and that diversification be used to reduce risk. And those principles all remain at the core of T. Rowe Price today. That sounds like an advertisement. All right, T. Rowe Price went public in 1986.
maybe they'll sponsor.
And it was added to the S&P in 1999. So if we look at this company, the PE is 14.77. It's got a 3% dividend. That's, that's quite nice. Return on invested capital of 24.35%. Now, return on invested capital is the return on all of the all of the capital invested in the company, including stock market capitalization and debt. Okay? But in this case, it's the same as return on equity because the company has no debt. All right? In fact, it has 1.58 billion in cash and no debt, which is a great balance sheet. Now, here's the kicker, though. So everything looks great. All right? So I say if the return on invested capital is 24.35% and the PE is only 14.77, that is excellent. When the PE and the ROIC are equal in number, then I think it's about fairly valued. When you have a dramatic difference between the PE and the ROIC is higher, that's an indication that it's a good, cheap stock. Now, also, this is actually you would expect growth to be low, but the analysts are expecting 10% growth this year. So I see no reason not to buy this stock. I would
Wow.
recommend it as part of your portfolio,
Wow.
definitely.
It's very rare that you get like such an affirmation out of you. I mean,
Yeah,
sometimes
yeah.
you go with a stock, but very rarely are you this.
I like it. I think it's undervalued here. This is a stock that has gone from $85 in 2014 to $75 now.
Wow.
So it's really, been bad, weak performance in the market. And it's finally looking like it's undervalued. A lot of that is because people have been kind of getting out of investment managers and into ETFs or like index funds.
Okay.
So that's the problem, and I think that's probably why this stock looks so cheap. But you can't argue with 10% growth in earnings.
No.
I mean, that's growth. So they're going to be adding clients somehow. And I'm not really surprised either. I think they have a good style, and I like the company.
Nice.
All right, so now I'm going to talk about a local company, all right? One that is located downtown, headquarters. So Federated Investors. Oh, by the way,
Okay, I know them.
yeah, my sources for the other one, T. Rowe Price, were Wikipedia and WSJ.com, which I always use. And then another pedia, Investopedia.
Ooh, another Pedia.
Yeah, they had a little
Getting the love.
biography on Thomas Rowe Price. All right, Federated Investors. All right, for this one, my sources are Wikipedia, WSJ.com. Also, the Post-Gazette,
Ooh.
Pittsburgh Post-Gazette
Local.
obituary, dated May 12th, 2017, by Len Boselevich. And then a Federated Press release dated the same day, May 12th, 2017. Okay, so Jack Donahue was born in Pittsburgh in 1924. Okay, so I can't really imagine what the city was like then.
That's a Pittsburgh name, too.
Yeah.
There's so many Donahues in Pittsburgh.
Yeah,
aren't
there
I mean,
are.
Yeah.
In fact, like he has like over 100 grandkids.
I'm not surprised. I
Yeah.
hear that name like to this day all the time.
Yeah, yeah. So he was born in Pittsburgh in 1924. He grew up in Pittsburgh, attending Central Catholic and going on to West Point, where he graduated in 1946. It was a good time to graduate rather than 1944 or something like that, when you'd have to go right into the
Yeah.
war. So he graduated in 46 after the war was over. He was commissioned into the Army Air Corps. That was like the predecessor to the Air Force, where he excelled as a pilot of single-engine planes. And this is right from the Federated website. Delighting in carrying out spins and loops, I thought that was funny. I could see the co-pilot or the back gunner guy being like, Jack, don't do it. Don't do it again. He's like, woo, I want to do another loop.
That's funny.
All right. However, he was also interested in the stock market and finance, very much so. When he saw Forbes magazine offering a closeout sale on a stock market correspondence class, I don't really what is that correspondence like?
I don't understand.
From the stock market, or is it like I can correspond with you? I don't know.
Yeah, I don't know.
Correspondence class for a then financially risky $49. He enrolled in the class, okay, setting in motion the beginning of a lifelong career in the investment management industry. Mm-hmm. Jack was especially interested in mutual funds, okay, now, which were not yet a popular form of investing. So a mutual fund, if you don't know, is just like a collection of different stocks that have been selected based on a certain criteria. You buy them all together, you know? So that helps you in the sense that it's more diversified than buying one stock. So, for example, if you were all invested in Company A, mm-hmm. and, you know, it turned out there was a big scandal and Company A's product didn't actually work and it goes out of business, you know, you lose everything. But if you invest in, you know, A through Z, and they're all the same type of company, and then one goes bankrupt, well, another one probably does super well to counterbalance it. So it's much better to have a diversified portfolio. And it goes beyond that, too. That's kind of just a simple example.
Sure.
You know, the mutual funds were not yet popular, mm-hmm. But he felt so strongly that mutual funds were the everyday person's key to financial security that he wanted to share the idea with everyone he met. Now, that's directly from Federated's site. I was like, oh, boy, he must have been great to sit next to.
So, an interesting aside, I don't want to dive into this too much, but their P.O. box is 420. No, they're not. That's another one. I'm sorry, Federated Investors is not 420.
Oh, okay.
But if it was, I just...
But if it was...
like, with the weed industry coming into Pittsburgh, like, are they going to try to outbid them for that? Yeah.
Oh, yeah, right. They could sell that for something. Okay, so after that... All right, let's see. Where did I write the rest of this? Okay, so that after...
He was just so into it, his pen went wild.
Yeah, after leaving the Air Corps in 1950, all right, Jack began selling mutual funds. Surprisingly, he found a job where he could sell mutual funds, which were like the thrill of his life at the time. He sold them on commission, but he was a smart guy, and he quickly realized he could do better forming his own company. So he founded Federated Investors with two high school friends. In fact, they were classmates at Central, which I didn't know. That's kind of wild. Two classmates, you get along that well. In 1955, Richard Fisher and Thomas Donnelly, with the conviction that the mutual fund industry would be a great success. Okay, they were obviously right. They were hugely popular. Mm-hmm. I guess but it really revved up like in the 70s and 80s, I think. And into the early 90s, you know, they're super popular. They're becoming less popular now, as I said. ETFs, electronically traded funds, are eating into their profitability. He was right. Business took off, and today Federated is a much larger company. It employs about 1,400 people worldwide, managing and distributing investment products to institutions, financial intermediaries, and investors around the world. Okay, so it's kind of a similar firm to T. Rowe Price in the way it operates. Mm-hmm. You know,
not as cool of a name though.
Yeah, more generic name, I guess. And it's a little more conservative. I would say they emphasize fixed income a little more.
Conservative name, conservative.
And whereas T. Rowe Price, you know, based on the fact that it was founded by the father of growth investing, is a little more aggressive. Okay, the PE on Federated. By the way, Federated. I don't own either of these stocks, although I'm interested in T Rowe in buying that one, but I don't own it currently. Federated is a stock that I have owned, but I do not currently own.
Not interested at all.
I'm going to tell you.
Oh, okay.
All right, so the PE is 13.36. The dividend is 3.6%, which is very nice. It's a great dividend. So you could just buy it and collect the 3.6%. You know what? I would rather do that than buy some kind of bond where you have to put your money in.
Sure.
The great thing about this is it's got a 25.17% return on invested capital. That's excellent. So it's just like T. Rowe Price in that regard. It has no net debt, which is a great situation, but not quite as good as T. Rowe's where they had all that cash. But that's probably because they pay a bigger dividend, so they're paying the cash out.
Sure. Yeah.
But here's the thing. The analysts think the earnings per share are going to stay flat this year compared to last. So that's pretty weak. That sounds like they are probably suffering some repercussions from the competition from the ETF and index funds industry. So somehow T. Rowe seems to be bucking the trend, and they're in even better value. So I would buy T. Rowe Price. Federated is good value, but doesn't have that growth spark to it. Federated stock has gone from $31 in 2014 to $28 today. So, you can see it has no great guns there. And it's got a market cap of $2.85 billion. At any rate, very interesting company, and I'm going to keep my eye on it for you. And we'll talk about it again if it starts to look really juicy.
Nice.
Yeah, local. But
Shop local.
But stick with T. Rowe for tonight. And with that, we're out of funny money, folks.
All right.